I want to welcome Callum Thomas. He is the founder and head of research at Top Down Charts. His work is sought after by institutional and retail investors all around the world. Very excited to have him on. Welcome, Callum.
Great to be here.
I want to start by saying I'm a huge fan of your top-down macro investment approach. I truly think it's the best approach because, to use an analogy, you want to see the overall forest before you can start looking at trees. And, buying a beautiful tree in a forest that's about to burn down is never a good idea. So for those who don't know, can you please share a bit about your big picture approach and how you formulate your investment ideas?
Yeah, certainly. And I guess before I get into it, it's always worth to mention that even if we agree that my approach is the best approach, I'm always surprised and always amazed as to see how many different approaches there are to tackling this problem of investments. How do we get good returns? When I was back on the buy side, part of my role there was looking at allocating money to other fund managers. And certainly from that, I got to have a pretty good insight into how multiple different firms approach various different markets from different angles. And so even if I was going to say that my approach is pretty good, there's a lot of different ways to go about this interesting problem, which is called investing. But anyway, in terms of how I approach things, it's basically to start from a situation of pragmatism and being as data-driven, chart-driven, indicator-driven as possible, but not fully quant. So it's a quantitative approach with a judgment overlay is probably the easiest way to describe it, and being pragmatic as opposed to dogmatic in terms of what we actually look at. So being as comfortable looking at technical analysis indicators as looking at valuation indicators. And, I can tell you that I've definitely come across very experienced people who I've talked about valuations to and they'll rubbish it, and equally who I've talked about technicals to, and they'll equally rubbish it. So, there is a lot of dogmatism out there, and so I think it's important to address that in passing. But in terms of how I do it, I typically tend to want to start with valuation as the anchor, and that's one of the most important indicators for longer term investing, certainly for strategic asset allocation purposes, because valuation tends to be a pretty reliable signal across, say a 5 to 10 year window. Problem is, there's a lot of people who either can't or don't want to look at that kind of window. Like even professional investment company who says that they're long-term strategic investors, the reality is that they've probably got quarterly performance rankings for the industry, and this sort of peer awareness means that they almost has this constraint of where they might otherwise want to just shut their eyes and buy some cheap valuations. They might actually have to take a bit more nuance to the approach, or say yep, it's cheap, but we're not going to pile on board just yet because we need to see more evidence. And that's where the other factors come in. So the next thing I would look at is cycle indicators, and it can be a little bit counterintuitive there. So for the earnings economic cycle, in the case of equities, the time where it's usually best to buy is when things look so bad that it's good. So that, earnings growth would be collapsing, economic indicators would be plummeting. That's typically one of the best times to buy. The second best time to buy is when you have that, but then they start to turn the corner a bit, because it's sort of like, rather than trying to catch the falling knife as such, you go and pick it up out of the ground. But then the other thing is, of course, monetary policy, which I think is quite interesting really to look at that factor last year, just this massive wave of monetary easing. And if you think about fundamentals as earnings, macro, policy, the quality of the investment, monetary policy is one of the most important fundamentals. But then, there was this sort of popular sort of theme or narrative last year that, the fundamentals don't matter. And it's like, well, they actually do matter, but you've got to make sure that you're, again, pragmatic about it, not dogmatic. Just because you think that a certain fundamental should matter more than another one doesn't mean that the market's going to agree with you. And so that brings me to sort of one of my maxims or axioms of investing, is that you've got to trade not what you want to see, but what you actually see. So don't try and impose your opinion on the market, because it's not about being right. Ultimately, it's about making money. So those are kind of like the core medium-term factors that I look at: valuation, cycle, monetary policy. Then the sort of final part, or the last mile, would be the tactical indicators. So sentiment, positioning, flows, and of course technicals. Now, I might actually get an idea that comes from the technical side of things, like some market might be breaking out, and I might go away and do the analysis and see if that actually makes sense, whether the case stacks up or whether it's something to go against. So, basically come up with a good strategic case and finesse the tactical picture around that.
Sounds great. And I read your 2021 strategy deck and got pretty excited by some of your core views. But before we get into your core views, I want to give you credit for accurately calling out the risk of the recent sell-off in commodities and the rising USD that we're seeing now. And now that it's happened, do you see further risk to the downside for commodities, at least in the short term, in a rising USD? And if so, for how long?
Yeah, I think with regards to the US dollar, my view would basically be that any rally that we get is probably just a short squeeze. It's probably just a short-term, short-lived rally, just a bit of a positioning clean out. And I think likewise on commodities, I think the outlook for commodities over the next few years is very bullish. And that's on the back of a number of things. Like for the last few years, we've had very weak capex by commodity producers, and that is basically setting up a future supply tailwind. The other thing is we've got, truly historic monetary and fiscal stimulus in the system, and that arguably creates a lot of fuel going forward for economic growth, for demand, for inflationary pressures. And, commodities are basically inflation, in many ways. But much like we've seen positioning and sentiment become very crowded to the bearish side for the US dollar, we've seen the opposite for commodities, so very bullish sentiment there. And also, just briefly to mention my view on the US dollar is, I'm still quite happy to be bearish medium term there. But it's just that, so again, the medium term outlook is consistent for the two, but then actually the short term outlook's also consistent, that we might get some sort of short term, short lived shakeout. As far as I'm concerned, it's not something that I'd like to, necessarily bet on or chase, where the short-term picture is different or goes against my sort of core view. I think that, any time that I've sort of tried to dabble in that, tended to not work out too well. So, I think having consistency of your view across the time frames can help you avoid sort of getting into trouble.
I try not to time the market short term either. And if it does dip, then I see it as a gift and a buying opportunity. So it's all good either way, win-win. So okay, so you're saying it would be kind of a short term rally you would see in the US dollar and dip in commodities, which we saw last week, and maybe a buying opportunity, right?
Yep.
Cool. So then I saw that you're overweight equities outside of the US, and that excited me because I see a lot of value out there. The charts are not looking particularly frothy at all, kind of all banging around along the floor. So, what makes you overweight equities outside of the US?
It's pretty interesting, really, because there's this pretty compelling strategic case which has been sort of building for the last few years. So, and that is, the valuation side of things is a very important part of that. And as I said before, that the valuation picture is very important for the longer term picture. And so the first place to look would be just looking at things like the PE10 ratio, so price to trailing 10-year average earnings. For the US, it's almost twice that of the rest of the world. And also, I guess, just looking at the absolute level of US valuations are, they're very close to .com levels, very high relative to their own history. And if you look at the rest of the world, they still look actually reasonable against long-term history. Even against recent history, they still look reasonable. So, not only does rest of the world look reasonable versus their own history, but they look quite cheap versus the US. And the US in and of itself is looking at risk, given where those pretty lofty starting point valuations are at. And so, that's looking at an aggregate index level. But if I look at breadth techniques, so I'm quite a fan of using market breadth analysis for, basically things that you might not normally look at. And so looking at the breadth of valuation, and from my data, I can see that 90% of countries are trading at least 20% cheaper than the US. So as I just outlined, it's true at the headline level, but it's actually quite a widespread issue as well. When I talk about this, I'll say, so global ex-US, cool, see the case there, which countries? And really, when I look at my analysis, it's like all of them. um, you know, everything except America. Which is not entirely true because there are a couple of standouts that also look expensive, such as the New Zealand market, which is trading more like the US rather than the rest of the world. But digression. The other thing that I think it's important to highlight too is just the tendency of global ex-US versus US relative performance. So you map out this relative performance line, tends to go in these sort of 10 to 15 year cycles of relative under and outperformance. And it really, we've had at least a decade of US outperforming the rest of the world. So I'd say that cycle is fairly long in the tooth and ready to turn. If I look at my capital market assumptions and just use just a projection based on sort of long-term expected returns, certainly it does give you this scenario or prediction where you could have a 5 to 10 year period of relative underperformance of US versus rest of the world. So that's kind of the strategic case. But again, that strategic case of rest of the world looks cheap, so just buy rest of the world, that case was basically true for the last few years. And if you went into that on the basis of that rationale, then you would have been seeing significant underperformance. So again, you can't just, if you're short-term aware, you can't just look at valuations. And so looking at the tactical picture, the US dollar is a big part of it. And so if you map out the relative performance line against the US dollar, you can see that they're marching a very similar path. US dollar has rolled over, and as I mentioned, I'm still happy with the bearish medium-term view there. So that, from a tactical or timing standpoint, that really does help the case for global versus US. And then the other point is just looking at the technicals, because sometimes at the end of the day, you can go and do all this analysis, but then you have to listen to the market, let it tell you where it's going to go, let it tell you what the near-term state of play is going to be. And if you look at the relative performance line, it's actually broken out against its 200-day moving average and against short-term resistance. So that's pretty key. And then also looking at the breadth again. So I've actually started mapping out the proportion of countries who are starting to outperform the US, and that has gone from almost zero last year to now almost 50%. So that kind of turnaround, from a technical standpoint, is definitely a bullish thing to be looking out for. So, I think we're at a sort of unique time there where there is this pretty compelling strategic case, which is also lining up with the tactical case, which is really what you want to see to raise your conviction levels up and to lower the threshold for action. Because, as a full-time strategist who works with portfolio managers, it's not enough for me to come up with an interesting idea. I have to try and lower the threshold for action, raise the amount of conviction that they can have in that idea. Otherwise, they're not going to do anything about it. They're not going to put it on. They're not going to put it on in size, and they may as well have not read it.
Yeah, no, all those indicators really do seem to be converging at one point. And like you said, if you just saw that, emerging markets are cheap compared to US 3 years ago, well, you would have missed out on a lot of gains, right? Because you'd be stuck. But you're saying on a timing perspective, does it all seem to be converging into 2021 as being kind of the year where foreign markets outperform US equities?
Yeah, to me, it looks like the turning point's already in. So if I look at the technical indicators, given the breakout or the initial breakouts there, I mean, if you weren't quite convinced, you could wait to see a little bit more follow through on that breakout, because there is such a thing as false dawns, and we have had a couple of false dawns along the way. So waiting to see perhaps the breadth expand further, to see a bit more enduring weakness in the US dollar, and to see just more follow through on the initial breakout that we've seen in foreign markets versus US.
Makes sense. And I also noticed that you are interested in not just ex-US, but ex-Asia countries, right, and markets. Is that because there's more value there that you can see compared to Asian markets?
Yeah, so this is something that most people don't really tend to look at, is actually differentiating within emerging markets, because I think emerging markets still look pretty compelling, even though it has become a pretty consensus call and sentiment is looking a little bit stretched. Again, if you look at sentiment for emerging market equities, it's actually looking fairly similar to, as I mentioned before, with commodities. But if you split emerging markets down the middle to basically Asia and ex-Asia, you get a pretty interesting picture emerging. So if you look at ex-Asia, so just to be clear, what we're talking about is Eastern Europe, Middle East, South Africa, Africa, and Latin America. Probably I would say parts of the world that sort of more Western investors probably wouldn't perhaps naturally look to. But there's also countries that a lot of these cases have pretty significant linkages to commodities. And, if you look at the absolute performance of the MSCI emerging ex-Asia, it actually maps fairly closely to the price action in commodities. But specifically, what's gotten me interested is a couple of angles in terms of relative value. So if you look at valuations for EM Asia, they're actually looking a little bit on the expensive side in absolute terms, whereas for emerging ex-Asia, it's still looking cheap, certainly reasonable. And really a little bit more interestingly also is that if you look at the currency side of things and, if you're a US dollar denominated investor and you're going and buying foreign investments, then you have to be aware of the currency effects because they can either help or hinder the case. And sometimes there is a decision to be made about hedging there. And so, i.e. taking the currency issue off the table by hedging it out. For emerging ex-Asia, or even just for emerging markets, it can tend to be a bit trickier to actually do that versus, for instance, say, European equities where you've just got one currency and it's a deeply liquid, well-established currency to trade, and so it's very easy to go and buy the forwards yourself or look for some sort of ETF that actually has the hedging embedded in it. Yeah, looking at the currency situation for emerging ex-Asia, the valuation ex-Asia currencies look very cheap against the US dollar and extremely cheap. You actually have to go back to the late 90s to find levels of relative value of EM ex-Asia currencies relative to Asia. So, I think when it comes to emerging in particular, you always want to be looking for, or at least getting a little bit more excited about, a situation where the equity case and the currency case actually line up. So they're both bullish, which is the situation now. And also if I look at allocations, so I've used basically aggregated up country ETF allocations to give a sort of implied level of allocations to EM ex-Asia. And it definitely looks very light, arguably under-allocated. And then also just looking at the relative performance of them. Last year, EM ex-Asia really significantly underperformed against Asia. And if you look at the past when you've seen that kind of deep, substantial underperformance, you tend to see a bit of give back in the subsequent years. So it's a kind of a simple rule of thumb that, poor performance is followed by better performance. So, it's like that line that everyone sort of throws out there in their investment marketing, that past performance is not a good indicator of future performance. Sometimes it's actually the opposite. So sometimes you could actually say that past performance is a reliable contrarian indicator of future performance. But that's a nerdy investment joke. So yeah, I think the case there looks pretty interesting. And again, it's also consistent with the view on commodities. So yeah, again, something that I think perhaps not that many people are looking at, but seems quite compelling to me.
And you did mention how ex-Asia emerging markets seems to trade in tandem with commodities, and you're also overweight commodities. So what is the bull case that you can see for commodities?
The CapEx part is pretty important. So capital expenditure. And basically, this goes back to this sort of market wisdom or rule of thumb or whatever you want to call it, that the best cure for low commodity prices is low commodity prices, because the lower commodity prices are, the less profitable it is to go and do new investment into commodity production. And therefore, down the track, if demand picks up, then supply is going to be caught too short. And it's sort of a little bit maybe counterintuitive, but basically the worse the supply is, the better that is for commodity prices. So an outlook of lower supply growth is a tailwind to commodities. So that's a big strategic part of it. And actually, just to mention it there, commodity producer capex is basically at record lows. And that's really a reflection of that secular bear market in commodities that we've been through. And, because if you look at the investment cycle, so for commodities, there's a demand cycle and then there's an investment cycle or supply cycle. The investment cycle is quite slow moving because, it does take a while to sort of get projects approved and raise capital and actually make the project produce the stuff. But then on the demand cycle tends to be a little bit more faster moving because it's, just the ebbs and flows of the economic outlook. And on the economic front or the demand front, clearly we've seen a turning of the corner. I think it's pretty clear there. And knock on wood, it seems that we're close to the nadir of the pandemic or the worst point. We've got multiple vaccines announced and, actually being distributed. So it's that part is more of an active work in progress now. And then, also just looking at the amount of stimulus in the system because, we can't simply rely on normalization of the way that we used to do things, but also just, stimulus working its way through the part of the economy that is working and also into the parts of the economy that are figuring out new ways of working. So I think the demand outlook, the economic outlook is pretty compelling. Also the fact that we've got multiple governments, especially in particular Europe, Japan, and I think also potentially the US, but we need to see a bit more detail, is the idea of doing fiscal stimulus that is not just aimed at a short-term sugar hit, but also economic transformation. So Europe's got a 1.2 trillion program of economic transformation they want to do over the next few years. Japan has announced over $500 billion for the same thing. And so they've talked about, clean energy and digital transformation. And then, of course, in the US, the big one there is infrastructure, which is to put a lot of money into infrastructure. And that's the kind of thing that helps, I think, lift growth and also demand for commodities. So I think the supply outlook, the demand outlook, then also marrying that up to the US dollar outlook. If you're bearish US dollar, then that tends to be good for commodities. And so also looking at cycles, the technical front looks pretty good. Breadth, very strong. So I think the outlook there is pretty compelling. Valuations, designed my own valuation indicator for commodities, and that's showing up as, despite the rebound, still quite cheap. So I think that's compelling. One thing I would mention is that when you think about commodities, we're talking about, dozens of different, and in some cases extremely different and diverse markets. But, one high level differentiation I'd make is that I'd be more bullish on commodities ex gold relative to gold. I think that gold is probably in for at least a year, potentially more, of consolidation at best. This sort of upswing in the economy, likely upswing in real yields, improvement in risk sentiment, improvement in the general sentiment, likely it puts a lid on gold. And I think that, if you look at the Fed's basically done. They're not going to be doing any more substantial easing from this point, from an incremental standpoint. And, you've got fiscal policy basically taking up all the slack in terms of the stimulus outlook. So, and again, that would tend to put pressure upwards on real yields. So, that would be my sort of nuance to add to that picture. But I think pretty interesting setup there. And I think just in general, it looks like, the next decade, or at least the next few years, are going to be really quite interesting for asset allocation. And you kind of can fall into this trap of crying wolf over things like inflation, over, return of bull market and commodities. But I think that, it's the elements that are in place are really unlike anything that we've seen in recent history. So, falling into this trap of thinking that it's going to be just the same as the last 10 years, I think is very risky.
I mean, you explained that so well. It's like you almost answered every one of my questions. But I love the non-consensus call against gold. And I'd love to dig deeper into that because most people might say, oh, well, they're going to print money. They're going to do the fiscal stimulus. That'll cause inflation to go up, which would increase the gold price. but you're saying relative to other commodities, it won't do quite as well. And part of that is the real yields rising, right?
Yep.
But do you really think the Fed will allow real yields to rise? Because, just given how indebted the entire US ecosystem is, like, do you think they can afford yields to rise?
Well, I guess in the end, it comes down to sort of like just looking at the composition of it. So what actually are real yields? So in the strictest definition, it's nominal yields minus inflation expectations or, inflation swaps. And so to have a view on real yields, one way to do that is just to say, oh, what is my view on inflation expectations and nominal yields? So, I think that inflation expectations continue to trend upwards. I think that that's kind of hard to argue against, especially if you're bullish commodities. But I also think that nominal yields at this point do actually keep pace a lot more. So the initial upswing in inflation expectations was inflation expectations heading away by themselves and real yields getting left behind. But I think that we see them actually both moving up and going forward. So I would say that the case for higher nominal yields is pretty clear. The more fiscal stimulus they do, the greater the supply increase, and so that impacts on the supply demand or flow situation for treasuries. But I think an important point there, which I kind of touched on, but I want to make sure that I belabor this point, is that you've got the new Treasury Secretary, or the incoming Treasury Secretary, Janet Yellen. So one thing that she mentioned a lot during her tenure as Fed chair is that monetary policy is great. It's good. It's a good tool for managing the cycle, but it has its limits. And ideally, when monetary policy reaches its limits, you want fiscal policy to do more of the heavy lifting. And just the headlines that we've had about more fiscal, more fiscal, more fiscal, every dollar of fiscal stimulus that we see basically takes some of the pressure off the Fed to do any further stimulus, and particularly so given that fiscal can be more direct. You can basically direct the stimulus to the exact part of the economy that you want, whereas monetary, it's a bit more indirect. It's a bit more of a blunt tool. Often, all that ends up happening if you cut rates, lower yields, is that the housing market goes up. And the housing market is a key transmission mechanism for monetary policy. But, housing market valuations are pretty expensive. And so if you the more monetary stimulus you do, the more you send up house prices. And, I can speak for at least New Zealand that we've had that definitely happen. And it's becoming a political issue. So it actually kind of puts another constraint on monetary policy. So, I think that a combination of more fiscal, the sort of just kind of the constraints on monetary, the fact that we've also actually seen inflation and growth turn the corner, I think it's harder for the Fed to argue that we should be doing more stimulus. I think the only way that you would get the Fed doing sort of anything different to what they're doing now, in terms of incremental easing or, a preventing of financial conditions from tightening, would be that, bond yields all of a sudden spiked, say, 100 basis points across the period of a couple of weeks. If the Fed saw that, it would probably step in, either do some form of further quantitative easing or yield curve control, or even just yield price caps. So just saying, okay, high market, we're not going to let the 10-year yield go above 1.5%, for instance. I think that's the only way that you see the Fed doing more. And so tying that back to gold, I think a big narrative of the gold price rally last year was Fed's doing all this easing, quantitative easing, blah, blah, blah. And which is true, and money supply expansion maps pretty well to the price of gold. So, yep, fair enough. Not arguing that against that at all, but I think that just that window is closing now, and monetary policy at least doesn't become a tailwind, maybe a headwind. Probably more of a discussion for next year. But certainly the tailwinds to gold that were fairly clear and evident last year, unlikely to be so this year. But yeah, in terms of the real yield aspect, I basically look at two things as driving real yields. So one is risk sentiment, the other is growth outlook, and greater fiscal stimulus probably improves the growth outlook, probably improves risk sentiment, and so probably sends real yields up, or at least stops them from falling. So and that's why I kind of hedged the view a little bit there, is that it's unlikely that gold rallies. Maybe the best case is that it just goes sideways, but there's still some pretty heavily crowded sentiment and positioning and flows on gold. So maybe that group of investors or traders that piled into gold, on that narrative last year, when they see gold just meandering along, not really doing anything, maybe they decide that there's better opportunities elsewhere and start to put a bit of selling pressure on there. So I think I could be convinced that it goes sideways and consolidates, but I think that there is actually be a case to be made, but certainly at least a relative case to be made. I think energy versus gold is pretty compelling, because all that stuff that I talked about is actually fairly bullish for energy. So yeah, it's another angle there. But yeah, seems compelling to me. But yeah, there's sort of an interesting thing about this kind of profession, is that you can be right in your analysis, and be right on your judgment, all the rest of it, but then the facts can change, and that that initial view, it's like, yes, you were right, but guess what? Things have changed, so you're wrong now. So you better change your conclusion.
Yeah, no, that's actually a brilliant point. And I think it's something that a lot of gold bugs may be missing, is that the fiscal stimulus is going to cause growth, which is going to cause the economy to grow, and which is going to cause the commodities that go into the economy to go up in price. But that's more a growth kind of story versus a defensive, protect me from investing story, which is where gold is.
Yeah.
So you're kind of counting on that growth to kind of help the economy and actually boost things. And whereas I think the gold bug story is more just, let's hide from the dollar, hide from the economy in general. So that's really a great point to understand. And I can see how in a growth environment, gold just wouldn't be as desirable.
Yeah, I mean, it is probably still going to contain, have some sort of a defensive role, because if what I've laid out is wrong, then that probably shows up in low real yields, and so gold probably does rally. And I think that going into the next cycle is certainly going to come back. But I think again, that whole pragmatism versus dogmatism, I think it's important, or at least from my philosophy, is to look at assets from a cycle perspective, from a portfolio-wide perspective, and not get too caught up in these sort of grand narratives that can sometimes dominate and confuse things in the short term.
It does seem like the dollar is kind of the crux around all of these investment ideas kind of hinge, right? Like investing overseas, investing in commodities. But your call is, it seems like that the dollar is going to come down because they're going to debase it. But instead of kind of causing a panic, it's going to cause a growth concept. And that's going to stimulate the economy and kind of make things boom. But the US economy won't do as well because the dollar will be crashing, essentially, or at least lowering compared to other countries, right?
I think the US economy still does well. It's just, given where valuations are, given the broader setup, I think the rest of the world markets look a bit more compelling.
Usually when the US dollar goes down, other countries seem to do better. Do you have anything else you would want to share before we talk about, how people can find you and learn more?
No, I think we had a pretty good trip around the world there, and I think these are going to be some themes and ideas that are going to be with us potentially for, I think that this is a good year in terms of turning points, but I think these themes are going to be with us for the next few years.
I think so. And I love the value kind of approach and how you're looking for stuff people aren't chasing already. You're looking at stuff that has a lot more upside and, has some value, which is great.
Yeah.
So it all seems to make a lot of sense. So where can people go to learn more?
So the Easiest way is just to follow me on social media, so either on Twitter or LinkedIn. If you are a professional investor, so if you're, RIA, portfolio manager, definitely get in touch. Still accepting new institutional investor clients, and definitely happy to work with people that sort of share a like-mindedness in terms of philosophy.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.